Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, who is tax partner at GRF CPAs and Advisors here in Bethesda, Maryland. And my business partner, Corby McGordon, is with us here today as well. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building sellable or transferable business value, and then for planning your eventual and actually inevitable exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. Today's focus is on owners who want to exit in the next 2 to 3 years with a sale to a third party. If you've listened to us at all in the past, you've heard our constant exhortation, we over communicate this, to begin planning for your eventual exit as soon as possible. Of course, it only increases your chances for a successful exit in the future. But it may have only been in the last few years that you've even heard of exit planning and its importance, and maybe it's through this podcast. And so, in that case, it would make sense that you might not have a plan in place that was either strategic or intentional. And perhaps at this point, you find yourself wanting to exit in the next 2 to 3 years, and somehow you've decided that the sale to a third party is really what you want to do, or perhaps you figured out it's the only thing I really can do. Well, and then you need to know what to focus on to increase the attractiveness of your business when you take it to market in the next 2 to 3 years, and then to maximize the payout. And so that's the question we want to talk about today. What should I work on if I want to sell to a third party in the next 2 to 3 years? So in the next 30 minutes or so, we're going to highlight some what we think are key areas for focus and positioning your business for a successful transaction. And of course, if you need help with any of this, contact us. It's what we do. So guys, Walter, Corb, where do we get started with this? The first thing that comes to my mind, of course, is, and again, this is mainly we're going to be focusing on the business, positioning the business, because there's so much more, of course, that needs to be planned for on the personal side and all like that. But this conversation is going to be mostly focused on positioning the business for a successful transaction. Of course, the first thing that comes to my mind is financial performance. But what about you guys? What comes to your mind, and anything that you want to say about financial performance, because both of you really work in that space in what we do.
Yeah. I mean, I think, if you boil it down to its simplest terms, and the amount you're going to get for your company is based on the benefit stream and the riskiness of that benefit stream. So I agree with you. I mean, those are financial issues. With the benefit stream, it's a matter of optimizing revenue and expenses. With the riskiness, we'll obviously go into much more detail. It's things like repeatability, systems, diversification, stuff like that.
Mm-hmm. Mm-hmm. Yeah, the analogy that comes to mind, even as you're introducing this topic, Pat, is when you go to sell a house, oftentimes there's a flurry of activity 2 months before you sell it to get it all cleaned up. Which you don't want to do. But similarly, the rooms in the house, it's bathrooms, kitchens, all the rest of that kind of stuff. So hopefully what we'll cover today is kind of a similar analogy, the bones of what does that financial performance look like? And, you buy a house to live in it, you buy a business to generate cash when the day is done. Mm-hmm. So, one of the first things I would touch on is just the ability to demonstrate that the business does indeed generate cash, which implies clean financials, routine financials, understandable financials that someone can pick up, and as they're doing the home inspection, they can look at it and they're believable.
Mm-hmm. Yeah, and I think one point I would add, kind of piggyback on what you just said, Corby, which just kind of popped in my mind. If you've never had your outside accounting firm prepare financial statements for you, which, a lot of our clients, they use QuickBooks, and, they might not have any debt, so the bank's not requiring financials. In my opinion, it's worth it to have your accounting firm do what's called a reviewed financial statement. So it's not as expensive as an audit, which would probably be a waste of money, but it's better than a compilation. So those are the three levels: compilation, review, audit. If you have reviewed financial statements for the prospective buyer to look at, that's going to automatically give them a certain comfort level.
Yeah. And so how many years in arrears it clearly, I mean, if you have them reviewed every year, that's going to be fantastic. But when you go to sell in 2 to 3 years, and the buyer is doing their due diligence, and they look and they see reviewed, you had them reviewed just the last year. Is that sufficient, or should they go back even further?
Yeah, I mean, that's better than nothing, but 3 years would be great. 2 years would be good.
Mm-hmm.
And I think 1 would be kind of the bare minimum.
Mm-hmm. Yep.
Yeah, another thought that comes to mind there, a key issue in selling to a third party is consistent operating systems. And doing what Walter just said, to a degree, validates some of your most critical, quote, operating systems, i.e., do you do finances correctly? That's just huge. And to do it 3-4 years out from sale, at least, if you're not doing it correctly, it gives you time to adjust, get your house in order, get the processes in order, so that when the time comes, that the books are clean and there is that home inspection seal of approval that, yep, and they were done right.
Yeah. And the other thing that the financial statement is going to bring a value is, a lot of small businesses run on a cash basis. So their tax returns are cash basis. They may not be real concerned about payables and things like that. But when you get a financial statement done, it's going to be done according to generally accepted accounting principles, or GAAP, and it's going to be on an accrual basis. And accrual basis means you're accounting for receivables and payables. That's a much more accurate financial picture of your company than cash basis is. Cash basis is just you record income when you receive it and you record expenses when you pay them. Accrual basis is a much more accurate picture. And like if I was doing a valuation of your business, it would always be based on accrual financial statements. So that's another good reason to have financial statements prepared, because your buyer he's going to want to look at accrual.
Mm-hmm.
Yeah. Along this lines, another key element to it when the house is in order is the routine production of reports and review of reports, monthly at a minimum. So often business owners they'll get their accounting functioning, but they may look at the financials, they may not. But the financials are really your roadmap for how is the business running. And in a sale to a third party where a management team is going to transition, you want to be able to demonstrate that my management team actually understands how to run the business. So once a month, we look at our financial reports, we assess what went right, what went wrong, what the trends are, and we make corrections. That validates that this is a well-run company and we understand our business. COVID was unique, but on the other hand, stuff happens, the environment happens. So there will always be that need to react or respond to outside pressures, internal issues, et cetera. And routine review of financial statements show that I'm keeping score, I'm keeping short counts, I'm making course corrections as I need to. Therefore, Mr. and Ms. Buyer, the future of this business is bright because the team knows what they're doing.
Yeah. And if the buyer doesn't have real warm, fuzzy feelings and confidence that you've been staying on top of that as the seller, which is really the lifeblood of the whole organization, then they can very easily start to lack confidence in other areas of your business. Isn't that right? And wouldn't you guys agree with that? I mean, if
Yeah.
if you, the seller, are not on top of the financials, you don't even look at them, you don't even produce them, or they're sloppy, and your controls are sloppy, then goodness gracious, if that's sloppy, what else is going to be sloppy in this business?
Yeah, the other point that I think is really important that Corby's kind of alluding to is, if I'm the buyer of a company and, I come in, I'm looking at your books and you're like, well, we're forecasting 10% growth every year for the next 5 years. And I'm like, okay, show me your past budgets and projections. And they're like, well, all I have is historical financial statements. We don't do budgeting or projections. Well, then my default is going to be, number one, probably assume much less growth, or best case scenario for the seller is I'm going to say, okay, well, I'll pay you X. And if we really do hit those 10% targets, I'll pay you more. Whereas if you're a company where you and Corby have been working with, where Corby demands budgets and projections, and you can show that buyer, here's our projections for the last 3 years, actual versus projected, here's our budgets, then you're going to be able to say, and this is what we're projecting now. And I'm not going to have much of an argument because you're going to show me that you thought about it and you hit your targets.
Yeah, it's actually going to mean something. And Corby often points this out with our clients, that you can start your negotiating point can start at a higher level if you're able to actually document and prove on paper, or make a case on paper that what you're projecting for the future is realistic, and it is based on past performance.
Yeah. So, I think one thing that hits upon is, the better your records and the better your performance, less likely you're going to get stuck with a large earnout. You're going to get more of your price in the base. The other thing, when we think of price, the way companies sell is you sell your company and the buyer expects a certain amount of working capital to be included in the purchase price. And that can be anywhere from, 3 to 9 months. And what I've been seeing, most normally is the buyer will say, well, we'll just look at your historical records, and whatever your average working capital's been for the past 3 to 9 months, sometimes longer, that's what we're going to want. So it's important during this 2 to 3 year period that you're monitoring your working capital, because just leaving money sitting around in the company increases your working capital. So that's not going to be a good idea.
Yeah,
so you're going to want to kind of monitor
that. For instance, leaving PPP money.
Great example.
That's
great example.
Anomaly sitting around that kind of jacks up your average, doesn't it? And
yeah. And, it's one of these things where maybe you can work it out with them. We've been unsuccessful in a couple of deals I've been involved with where we've tried to prove that the average working capital has really been excessive. So you're better off not having to go there. You're better off having bare bones working capital. It's a closely held company. You can always just put money back in if you need it. So that's a word of caution there regarding working capital.
Okay, so that's a lot about financial performance and financial controls right there, and we've got other things to talk about. We could take up the full 30 minutes with that.
I know.
But what about okay, so in closely held businesses like this, particularly with sole owner situations, there's a need to clean up expenses and removing personal items and normalizing earnings. Anything you guys want to say about that before we move on to another?
Well, like you and I have talked about, when you go to sell your company, you're going to have to remove all your yacht expenses, your personal plane, all that stuff you use personally. But realistically, for most clients, I think what we've seen in a few deals recently is you have family members working for you at inflated salaries. And like I said previously, you don't want to have to explain things. You're better off just cleaning them off so that they're not an issue. So I think that's one we see. Corby, you know, when you're doing your budgeting and projections with clients, I'm sure you're seeing, you know, personal expenses. I mean, our clients are not real egregious in that area, but maybe club dues or maybe, you know, some entertainment, or, you know, there's the annual meeting type thing where they go out of town and do that. So, you know, all those things, to the extent that you can kind of clean them up for a couple of years prior to the sale, I think that definitely makes sense.
Yeah, I would agree with that. I had coffee with an individual who does financial due diligence for acquisitions, and she just emphasized that one, responsiveness is necessary, two, cleanliness is necessary. And so, like you just said in passing, Walter, the less you have to explain, just the more confidence there is in the end result. And one other comment, even though, you know, we talk about financial performance, you know, I'm an operations guy, and financial performance is done by management people. And so even as we talk about forecasting and managing, you don't start doing it when you're going to sell, because the team doesn't actually know how to do it. If they have done it for 3 years, they are trained to do it, which also gives a buyer confidence that the team knows how to execute on a budget. They know how to actually accomplish a forecast, you know, and hit it. They know the strategy. How do we grow by 10%, rather than just, well, here's a bunch of numbers that we hope to hit, and hopefully the accountants are going to have it kick out. It doesn't work that way.
Yeah.
Yeah. And hey, what about, actually, this kind of falls into the financial performance category too. Weeding out less profitable clients. You know, buyers want to identify what's good and not so good revenue, what's good revenue, what's bad revenue. And what are your thoughts about that piece, weeding out or just getting rid of, if you will?
You know, it's interesting. I can hear what Corby has to say, because as you're running your business, you know, obviously you don't want clients who are not profitable, and you want to be able to focus, you want to be able to have clients that are the highest level of profitability possible. But, you know, there are some industries, especially, that are sold on revenue. And there is something to be said for bigger is better. So, you know, you don't want to get rid of, you don't want to just do a wholesale reduction in your top line.
Right.
But but you do need to carefully monitor the bottom lines. When you're talking about your multiple, you know, that's one way a multiple is derived, is they compare your financial performance to your peer group. And a big piece of that is profitability. So it's kind of a fine line, but it's something you need to figure out what's more important in your industry.
Yeah, a big piece of it's profitability, and a big piece of it, to your prior point, is revenue.
Yeah.
Yeah, and again, I agree with what Walter says, and you have almost two types of businesses, where you've got project-oriented businesses, and then you have product-oriented businesses, and the principle is still the same. Fundamentally is, first you got to understand who are the profitable clients, and or what are my profitable products, what are less profitable, what are more profitable, so that there's the ability to actually demonstrate understanding. And a lot of financial statements I look at, you can't tell. They may have 4 lines of revenue and they have 1 lump of cost of goods. You can't tell which product is most profitable. Secondarily, then, there's nothing wrong. I agree with what Walter said. Nothing wrong with keeping a less profitable client or line of business. But what we want is, we want to have an answer when a buyer says, well, why? Why do you do that? And if the answer is, well, it still contributes to my bottom line, it still leverages me into this market, that market, that there are practical reasons, that's fine. And what I want to see overall in a projection, as well as historically, is top line has grown, and bottom line percentage as well, at least maintains or floats up as the volume floats up, so that it isn't just absolute and that I'm becoming less and less profitable, in terms of percentage, but that both percentage profitability and dollar profitability are both going up. That's a win-win.
Yeah. And, going back to what Corby was saying a few moments ago about, you need to start budgeting and doing projections early so that your management team, is familiar with it, knows how to do it. That led me to start thinking, and Pat, I'll ask you what you think, but that led me to start thinking about how important it is to have employment agreements, non-compete, stuff like that in place, because if your management team is, one of the features of the value of your company, you're going to need to make sure they're locked in.
Absolutely. Yeah. If this is where a lot of risk is, as we know, is in the key employees and important employees, because if the owner's done a really good job of delegating and decentralizing himself or herself from the business, then there are going to be some key people who are running the business. And so if the three of us are going to buy their business, then we need to know that those key people are locked down and that they're going to stick around at least for a period of transition, a year to 2 years, because they're the ones that make the business run and work. And so we do that with employment agreements and stay bonuses. Employment agreements, of course, would include hopefully non-compete, non-disclosure, and non-solicitation. Non-competes are, state by state, can be enforceable. Here in Maryland, they're really not, unless they got to be really written by an attorney like Mark Engel over at Lurch Early and Brewer. And even then, but anyway, employment agreements and then stay bonuses, bonuses that are meaningful, that are going to keep those key employees on the bus during any kind of transition, be it a sale, a lifetime transition of the owner as a sale, or if the owner were to die unexpectedly, we'd want those key employees to stick around for at least a while until the business could be sold. Those kinds of things. So yes, employment agreements and stay bonuses is something to focus on if you're going to exit in the next 2 to 3 years. Let me go back though to, you guys were talking about customers and clients a few minutes ago. There's another piece to that, and that is diversification of your customer base in regard to the percentage of revenue and how important that is, because there's risk there too. We can be too dependent on any one key employee, and oftentimes that's the owner or any one supplier. We got to be careful about that. But we can also be too dependent on one or two customers as a percentage of revenue. You guys want to speak to that piece?
Yeah.
I think you hit it right on the head. I mean, that's definitely a risk, and it definitely, if you're in that situation where you've got a customer, we usually look at, you don't want any one customer accounting for more than like 10% of your revenue. If you're in a situation where you got one who's like 50% of your revenue, I mean, that makes your benefit stream risky, especially if the relationship between that customer is with the owner, which usually it is.
Mm-hmm.
So that's definitely a big risk factor that a buyer is going to look at.
Yeah,
The same thing can run true for this if you have one supplier that you've been dependent on for a long time, and somehow that supplier relationship goes away or is damaged or something happens to it. There's risks there for us, the buyers, as well.
Mm-hmm. Mm-hmm. Yeah, and another aspect of the revenue diversification is, I agree with Walter, you want no more than 10%. At the same time, there are industries like the government contracting world where if you have a large client, however, you've got a contract that extends out for 5 years,
Right.
there's a legal surety of that revenue, it's less risky. Flip side to that is a lot of times we run into clients where they have relationships with people and they actually don't have contracts. It's a handshake, with the owner, et cetera, or they never got around to it. And it's a line to walk, because I'm all for, doing business, trusting people, et cetera. At the same time, a buyer wants to trust and verify. And so the more the documentation, the contracts, the agreements are in place, and the longer term they can be, the more risk is mitigated as well. It firms up the surety of future revenues.
Yeah, great point.
Yeah. How about Walter, tax planning? If 2 to 3 years out, we're going to sell 2 to 3 years out. That's our game plan. That's our time frame. What would you say about tax planning and having that as an emphasis and a focus?
Well, if you're an S corp, you're in pretty good shape, because you don't need to zero out the profit to avoid double tax. So you don't have to take a big bonus at the end of the year, that type of thing. So you can kind of keep your salary on the lower, still realistic, but on the low end of realistic. If you're a C corp, you have a problem, because you need to zero out to be tax efficient. Now, usually if you're zeroing out by paying out large bonuses to the owners, that's not that bad, because you can show a buyer, look, this is what I took out, but this is a salary survey of what somebody would really get paid in my position. But you have things like you buy a bunch of equipment at the end of the year to zero out, that type of stuff. I mean, you're going to need, for those couple of years, you may end up paying some taxes, but you're going to see the benefit when you go to sell. So you just need to balance out between tax planning and exit planning for those few years.
Yeah. So a big idea there is get with your CPA as soon as possible.
Yeah.
And just talk about your particular situation, right?
Yeah.
Yeah. And there's also an element of, we've run into cases where to avoid taxes, owners have bought vehicles, et cetera, but they didn't really need them. So they spent money to avoid taxation.
Yeah.
Rather than thinking about, well, even if I have to pay some taxes, what's my true need for investment? Because again, when a buyer looks at potential future growth, they want to look as well as, how have you reinvested into the business, and how are you currently thinking about investing into the future of the business? Because that's part of the need for working capital.
Yeah.
And so you want to make the business decisions and then understand the taxation implications, rather than start with, let me pay no taxes, and back into, how do I use the money to reach that single goal?
Yeah.
All right. So guys, we've passed 30 minutes. Let's take a few more minutes here though. We mentioned this earlier, finalizing and documenting all your systems and processes. If I buy your business today, I want to be clear on how it runs, and I don't want to have to create new processes and systems or figure them out. And particularly if I have to hire new people, I want all of that to be very clean and streamlined. And so, and this is hard work. It's one of the hardest things, I think, for small business owners to make happen, it seems, because none of us like to do it. And so you either have to have your people on the bus in your organization do it and hold them accountable to it, or hire some outside help. And you can get folks, consultants, who can do this work for you. And it's well worth the money at the end of the day when you go to sell, but it needs to get done one way or another. And then, well, we mentioned employment agreements and stay bonuses. Differentiation, buyers want to know that the business that I'm interested in and buying is differentiated from the competition. Absolutely want to know that. What else comes to mind, guys?
I wanted to make an editorial on the whole process thing.
Yeah.
Because like you said, Pat, it's hard work. And, and I hate doing that kind of work. But just a couple of simple thoughts are one, how do you know what processes? If when someone asks how you do something, you say Bob does it, but that's the answer, or
Yeah.
Sally does it, that's not a good answer. All right. And then a real simple way to force a process is, as much as you cringe at paper, develop a form that routes from person to person for approval. By definition, creates a process, and it creates controls. And so even if you don't actually use a paper form, thinking through, if I had a form and it routed through the pipeline, what information must be on it, who must review it, who must approve it, voila, you have a form and you have a process documented.
Yeah, and we did a podcast episode with Andrea Donovan,
Mhm.
listeners who you could look for that podcast. We did it this year, I think, at some point. And Andrea does this kind of work, and she's really good at it. And so you might want to listen to that podcast.
Yep.
And then so differentiation, marketing strategy. More and more buyers want to see a marketing strategy that's documented and is has proven results. And then there's one other thing that I was had on my mind. Let's come to your.
One other thing, there's a concept called a SWOT analysis: strengths, weaknesses, opportunities, and threats. And you can read up on it and find all kinds of things, but simplistically speaking, it's being aware of collectively your business. What are its strengths? What are its weaknesses? What's happening out there that's an opportunity, and what's happening out there that's a threat? And a simple 1-hour exercise once a year, identifying that, helps demonstrate that we look in the mirror, we look at what might be happening, and we plan to minimize the harm, optimize the good.
Yep. Yeah, the other here I thought of, I remembered the other point I wanted to bring up, and we've also done podcasts on this in the past too, more than once, is cybersecurity and how that's becoming a bigger issue with
Mhm.
and you listeners, you can look back. We did podcasts with Melissa Musser, who works with Walter at GRF CPAs and Advisors, and one or two others. So pay attention to that. And so then too, we would probably recommend that you get an estimate of value on the business currently, just to see where you're at in relation to where you want to be in 2 to 3 years. So a financial gap analysis, we've talked a lot about this in the past, where with your financial advisor or wealth manager, you figured out what number you need net of taxes in 2 to 3 years when you sell to a third party. And then you get an objective third party estimate of value. We can do that for you as to what the fair market value would be now. And is there a gap? And if there's a gap, how can we indeed over the next 2 to 3 years increase the value of this business in order to fill that gap? I got a couple other things to mention, guys, on the personal level, but anything else come to mind in positioning the business to be attractive and to maximize the sale price if you've got a 2 to 3 year time frame? Anything that we should mention that we didn't mention?
The only other thing that comes to mind, just simply speaking, is an org chart. Can't tell you how often we ask for an org chart and nobody can come up with one. If a management team is part of what's passing on, that org chart that's up to date is real handy.
Well, that's a great point, isn't it? Because if because if we're buying the future, we're buying future financial performance, and we're also buying the future management of the organization. And that's there's probably not a more key non-financial driver of value
Exactly.
than the management team. And then if you can't show me in an org chart, I'm not going to get real,
Right.
my confidence is going to be at least a little bit shaken.
Yes. Yes.
So that's a great point there, Ian Corby. Other things to get done. This is more, on the personal side, but we're going to mention them anyway. And that's establish and document your exit objectives and goals. As we talk to transaction people, they say oftentimes owners are doing this at the deal table, and it actually results in the deal going sideways. So don't do that. Establish and write them down now, what you really want financially and values-based and legacy and all that. And start now. You've got time margin of 2 to 3 years. Start now to prepare for life after the business. The statistics tell us that the majority of business owners don't do that. And because they don't do that, they're miserable within 2 years of selling their business. So make sure to think about life after the business. Select a transaction intermediary now and get to know them. Start to select them, because you're going to need one of those to take your business to market and hopefully create a controlled auction for your business. And that would be either an investment banker or a business broker. And then lastly, I'll mention review your estate plan to ensure it's consistent with your expected sale proceeds. And this can be particularly important if you're charitably inclined, philanthropically inclined, and you're thinking that you would take a good chunk of the proceeds and invest it or donate it to charities or charity. There's some strategies that could be put in place to help minimize taxes on that end too. So review your estate plan. Those are just a few things. Walter, you want to close us at this point if you guys don't have anything else to add?
Sure, we'll do. So listeners, hope you found this helpful. I think we've done a pretty good job of highlighting things that you should be on the lookout for 2 to 3 years out from selling your business. And if you're in that situation, or even if you're not yet, if you need help preparing a exit strategy or any help with growing the value of your business, any of those things, please feel free to get in touch with us today. The easiest way to do that is at exitreadiness.com or email at exitreadiness.com. And if you use the code podcast when setting up a free exitreadiness.com account, you will receive a 10% discount on any products purchased. Pat, are you doing any kind of Black Thursday increased discount? Black Friday, right?
Black Friday. Okay, you know what I'll do? Yeah, we'll do a 20% and Black Thursday or whatever it is.
Friday.
Okay, so when is that? That's the day
after Thanksgiving. Yeah.
All right, so 20% the day after Thanksgiving. And what you would do is you'd use BF podcast would be the coupon. And I'll create that.
All right, you better be careful. Your website might crash that day. It's going to be like Amazon Prime Day.
Really?
So listeners, thanks for joining us. And until next time on the Exit Readiness podcast, this is Walter Dial and Pat Ennis with Corby McGordon signing off.